In our last episode, Iowa State University Extension and Outreach Farm and Ag Business Management Specialist Steve Johnson brought awareness of the crop insurance March 15th deadline. In this week's episode, we continue Steve's interview with a few of his market strategies for both new and old crop. Steve recommends farmers have a written market plan containing both a time objective and price objective. We sat down with Steve late February at the Farmers and Ranchers College's Crop Insurance Farm Bill Policy Update and More workshop to learn more about these market strategies.
Pre-harvest marketing is really key, and crop insurance is a part of that pre-harvest marketing strategy. So by taking revenue protection, you're guaranteed your actual production history, which is a 10-year simple average in most cases of when you grew that corn or soybean crop on that farm or farms. It's your APH times your level of coverage. And most farmers in Nebraska, I would anticipate, use 75, 80, or 85% level of coverage. That is your yield guarantee. But when you take revenue protection, you get to multiply your yield guarantee times the projected price, the simple average of December corn futures, November soybean futures in the month of February. We call that the projected price. We don't know that number until around March 1st or March 2nd, but under revenue protection, you get the higher of the projected price, that simple average in February, or the harvest price, the simple average in October. That guarantee of revenue is critical. That allows you to pre-harvest market those bushels that are guaranteed and trying to sell when the futures price is above the projected price. For the last 5 years in a row, that projected price turns out to be higher than the harvest price, which is the importance of having a pre-harvest marketing plan that matches up with your cash flow needs in the fall and winter, and especially on-farm versus commercial storage, trying to keep these extra bushels out of commercial storage and having some sort of a plan, whether that be a hedge through a commodity broker. More common is a hedge to arrive, working with your grain merchandiser, committing bushels to delivery, but not setting the basis on those bushels. Hedge to arrive are very common, especially when combined with revenue protection crop insurance.
According to Steve Johnson, Nebraska farmers are probably sitting on the largest volume of unpriced corn they have ever had. Due to this, Steve recommends farmers have a market plan for old crop corn and soybeans, containing both a time and price objective. For a time objective, he recommends taking advantage of uncertainty.
Taking advantage of uncertainty. In the winter, South America uncertainty for soybeans, and especially in the spring for both corn and soybeans, corn tends to rally into April, May, June, and peak. Soybeans can often peak in the winter with South America uncertainty because the majority of soybeans are now grown in the southern hemisphere. So having a time objective and a price objective, and that price objective will include futures price minus expected basis, and then some sort of a profit margin. But I would anticipate that we will likely see a rally in the late winter and spring months for corn because of weather uncertainty in the U.S. that will slow their planting progress and likely give us an opportunity to get additional bushels, both old and new crop bushels, priced.
It is important to have a market plan for old crop, but it's also vital to pay attention to new crop price objectives.
I think as far as new crop price objectives, for soybeans, we're there. I've been using 10, 10, 20, 10.30 per bushel. November, new crop soybeans. I think the better basis opportunities will likely be in late November, December. For a farmer that's delivering to a processor, he's going to have to negotiate that basis probably late summer. And we're going to have wider than normal basis, as I anticipate we're going to plant more beans in 18 than we did in 17. For corn, my price objectives are probably more in line with this $3.95 to $4.15. I think we'll rally corn. It'll be primarily based on the uncertainty of planting and the cold, wet conditions in the northern and eastern corn belt. We'll plant less corn, but our ending stocks are over 2.3 billion bushel, the largest number of bushels that we've had in 30 years. So I'm encouraging the farmers to lower their expectations. We call that the Hawkeye strategy in Iowa. So lower your expectations for the 2018 crop. We've got large ending stocks of both corn and soybeans. And even though we'll have fewer corn acres planted, I would anticipate that with growing conditions forecast to be INSO neutral during spring and summer, then transitioning to El Nino, our good growing conditions, farmers will want to take advantage of the uncertainty, especially weather uncertainty in South America in February and early March, and then in the Northern Hemisphere in April, May, June. But having a marketing plan in writing with price objectives and time objectives. Again, I'm using 10 to 10.30 per bushel November soybeans. I'm using $3.95 to $4.15 December corn.